Where is the housing market crash? We've been told for many months that the housing market is teetering on the precipice of a cliff from fellow YouTubers, Redditors, Tom's paranoia, and even mainstream media. But houses prices keep going up. Why? Are they all wrong? Are we wrong? We're going to take a deep dive in the numbers and the stats and try and figure out where's the crash, when is it going to come, and maybe do a daring prediction. Stick with us. Let's dig into it.
If you're looking at buying a house, these numbers will probably help you make a decision. Same thing with investing in an REIT or anything involving real estate right now, because it is confusing and just all over the place. Demographically, first of all, we want you to look at this chart. Okay, you see the numbers there? What you see is basically the average household size from the 1960s until now. And that average household size, as you can see, is decreasing. Now in the United States, millennials, my generation, Brian's Gen X, we have the average household size at 1.94 for a family. Now that means that we are not keeping pace with population growth.
And you're having kids later in life. You're going to school, you got a lot of student debt, you're getting out of school during the 2007 to 2011 financial crisis, you're not getting a job right out of college. There's more of you with degrees fighting for fewer jobs. I mean, I feel sorry for millennials that got out because they kind of got the short end of the stick. So you're waiting longer and later to get married because you want to be financially set to be able to get married and have kids. And it's just not working out.
Well, why is the United States still growing? Immigration. We have a lot of people coming into the country from other countries that is causing the population to grow on top of a regular childbirth rate. On top of that, we have to look at the next set of demographics here. Now this refers to somebody who's trying to buy a house. So take a look at these charts. These charts show the average income by generation. We have another one here that breaks it down by the median household income. Now that median number represents out of 100 people, you take number 50 out of the middle of the crowd, the person dead smack in the middle, and you pull them out and say, how much do you make? What is your average savings rate? How much do you spend on groceries? I don't know. But that's the person in the middle. We did not take the mean number because rich people skew that number ridiculously in the wrong direction.
What I want to really note on this chart is not just the median income, but the percent change, because salaries are going down. They're not as much as they were just from 2019 to 2020. So you're not making as much money. Houses are going through the roof. You do the math.
If you take a look at all of this, you're going to notice a few trends here. Average household affordability for a person making it, and we live in Michigan, is about non-existent. There's a graph here. If you go to the website, we've got posted here, and you can see the average household affordability index. You'll notice that almost nobody, whether in the bottom 25 or upper 75%, can afford the house they're in. So we've seen the charts on age demographics. We have the charts and all the information on the average household income. Now, what does that mean if you're buying a house? Well, if you're buying a house today and you live in Michigan, you make $63,000 on average. Now, that's household income. That is not individual income. That means if you got two earners in the household, that is what both of them make together. The average house cost in this state, now we've been looking for real estate just personally, just to see if this is actually true, is expensive. Now, it's not like California expensive. It's not like Austin, Texas expensive. It's Michigan expensive. But we're looking at about between $330,000, $389,000. Now, we can't find a house that's decent for about $389,000, especially not if you have two kids in your house. So we're going to assume that the averages that you see here are the right numbers. Given that number, $389,000, and the current today's interest rate, it's June 26th, I know my dates, June 26th.
2023.
So 2023, yeah, I know what year it is. So you look at the averages there, $389,000 house, you put what is, according to the charts we just showed you, a 13% down payment, but let's just assume that you paid 20% down on that house, and your interest rate is 6.69%, your payment is $2,500 a month. Now, you can get these numbers if you go to bankrate.com and you go to mortgage amortization calculator in the drop-down menu, and you can play with these numbers. If you go back in time when the interest rates were low at like 2.5%, you can see you can buy a whole heck of a lot more house than you could today. Today, the interest rates are a lot higher. And guess what? The Fed said they are not done. They came out even this week and they said, hey, look, we've got 2 more rate hikes to make this year. And then we might think about being done. They're still trying to fight the inflation battle. Why would they fight this battle? Well, one, the dollar has to be the reserve currency for the world. And number two, things like milk and homes and cars have to be affordable. We're right on the edge right now where they just aren't. I mean, $2,500 a month payment, you're making $63,000. Your take-home pay is somewhere between $4,200 and $4,400 a month. That is more than half of your take-home pay. And just to even qualify for a house, if you're an underwriter and you know this, they like to see a debt-to-income ratio around 30%. If you're looking at all those numbers and you're looking at all the costs that go into owning a home, I mean, you got just repairs, utilities. Oh, look, the roof leaked.
Taxes.
Taxes.
Don't forget about taxes. Everybody forgets about the taxes. So if you have an escrow account, it gets just put into your monthly payment. That goes up or down depending on tax. But every year when taxes go up, that payment goes up.
And guess what? They recalculate taxes when you buy the house. So it's not the taxes what they were. It's the taxes are what you're paying for.
Right.
So on top of that, we have a problem. The supply of the homes is getting abated right now. That supply was basically non-existent throughout COVID. Why? Well, nobody's buying a house because they're afraid of COVID. You can't foreclose on a house because the government stopped that, even though rates were super low, and construction just stopped.
And people who couldn't afford their payments during COVID were allowed to take those payments and put it at the end of their loan payment, so they had a couple of years of not having to pay.
In addition to that, we had a problem with during the Great Recession. Some of the younger people here won't remember this because they weren't buying houses back then, but the Great Recession pretty much put a big stop on construction activity, and it really hadn't quite recovered until very recently. So now we have construction booming. We've got the Fed raising rates. We've got affordability that's right on the edge. When the Fed raises rates, it's going to push it over the edge. And we have the foreclosures that are getting freed up. So when you look at all the averages, all the numbers are probably spewing across the screen for you to see. We have an affordability problem and we have a supply chain problem with homes that is getting abated. Do we know if it's going to be like the Great Recession? Probably not. I mean, it's probably not going to be that bad, but we're looking at a 20 to 30% at least correction somewhere in there. Might be a little bit less, might be a little bit more, depends on what happens. But if you're buying a home and you can afford to wait, just wait. If you can't wait, be very careful. And we're sorry you're getting shafted.
You're paying too much for your house.
You're paying too much.
Sorry.
Just hold on to it for a long time. So whatever you buy, just make sure time is your ally with stocks. It's the same way with real estate investment. Just hold on to it for a while. Now, if you're looking at buying an REIT, because REITs are forced to pay you based on their net income, double and triple check those quarterly reports and absolutely make sure that their cash flow statements aren't going to be negatively impacted by a huge drop, especially in the commercial sector. Residential doesn't look as bad as commercial does. Commercial looks awful right now. Right. So if you're buying a REIT that's like CIO or any one of the other, even an LA Capital, any one of those, double check the numbers and make sure that their cash flow and their income statements can afford a additional couple Fed rate hikes.
Right.
If they can, you'll be okay.
And go into the REIT and check what type of real estate that they invest in. Is it leasing apartment buildings? Is it office buildings and office space, which is going to get hammered? Is it house mortgages? Go figure out what that is, because that will make a difference as to which one you get as well.
We have a lot more metrics. There's a lot more finances. There's pages of notes and many different sites. I've toured about 30 homes myself, just looking for homes. In a non-scripted, off-the-cuff video, we're hoping you found this useful and helpful. There's a lot more coming. We're going to do our month 15 stock purchase very soon.
Watch that here.
We're hoping that we don't purchase the stock on the last day of the month. Like last month.
It's close. It's going to be close.
It's going to be close.
It's going to be the last day of the month. Sorry.
If you find value in this, thank you for watching. Please subscribe and watch more videos, because that will help us take videos like this and dig into the numbers even further, because right now We have a lot of information, and hopefully you found this concise and helpful.
Yep. We're on that 4,000 watch hour march. We're about 2,000 hours, and we're hoping that we get that so we can start to be able to do this more often.
And to sum it all up, we believe that a lot of these numbers that we're saying are going to start coming back to financial reality and sanity sometime this fall, winter. A lot of it depends on what the Fed does. Pay attention to what they do with rates. When they say they're done, a bottom isn't going to be too far behind it, and things are going to look a lot more positive and rosier for us. They're going to be fun and pleasant. So if you've been watching, thank you. Hope to see you in the next video. And as always,
Happy investing.
investing.